Welcome everybody to today's fireside. I am incredibly excited and enthused to welcome today's founder. This is our first founder fireside. We've had all these investors, which is nice. This is great. But Henry's going to talk about his story as the founder and now CEO of Carta, and staying with that incredible journey, that long ride journey. How many people here are using Carta? Like most of you. Yeah, it's a great product. Welcome, Henry. Okay. Excellent. All right. Go ahead.
I didn't go to Berkeley. I went to University of Michigan, which is the Berkeley of the Midwest in Ann Arbor. After that, I did enterprise software for a little while as a computer engineer, and then a salesperson of all things. I kind of straddled both technology and sales. And then I moved to France and went to grad school there, did a little bit of investment banking, and then moved to the Bay Area and kind of showed up without, following family, didn't know anybody. It was one of those things where I was an accidental entrepreneur. I never planned to do this. I just showed up in Palo Alto in 2011, and everybody was starting companies at that time. So it was one of those things like if you took drama class in high school and then suddenly you moved to Hollywood, you might audition just to see what it's like, to try it out. So I did the thing everybody did. I joined Hacker Dojo, which was at the time kind of an incubator in Mountain View, or it was shared co-working space. Got involved in the startup thing, started a company, and then shut it down. It failed miserably. I spent 2 years working on it. It was a bad version of Betterment or Wealthfront, if you've heard of the robo-advisors. I was probably 2 years early and also did a bad job at it. And so the company just didn't go anywhere. In hindsight, it worked out because out of that sort of going through sort of 6 months of trough of depression and figuring out what to do next, I ended up with what became eShares, which is this sort of cap table digital stock certificate problem. And that was in end of 2012, worked on it for a year, launched the company in January of 2014. I remember the first $120 we earned from a customer that paid us for something. I don't know where you are on that journey, but certainly the first time somebody paid you for something you built is like a magical moment in an entrepreneur's career. We made $720 that month, which was amazing. I remember the 10 of us in a room watching Stripe process the transaction, for the first time. At the time, we didn't know if Stripe would work, right? This was really early in Stripe's days too. 11 and a half, years later, we're 2,000 employees. We're about 350 million and ARR, annual recurring revenue. So I've kind of seen the whole, 11 years of how growth can happen. And that's it in a nutshell.
Wow, that's a lot of stuff packed into a nutshell. Let's start a little bit with the Carta mission, because I know you're a very mission-driven organization. Talk about that and how did it start and how has it evolved and changed?
I think we had two vectors on kind of the problem sets that we were trying to solve. So vector one was, hey, there's kind of this weird phenomenon in the world where you've got these very liquid, highly electronic, real-time, public stock markets, and you've got private stock, and private stock market, which just doesn't exist. It's all paper and opaque and illiquid. It's actually hard to find these days examples of two systems that should be so similar in so many ways that work so differently, right? It's this man-made, IPO line that separates these two things. So problem one was, hey, could we build the infrastructure that makes private markets look like public? That was the original idea. And if you look at, I think I published the seed deck for Carta, but if you look at the seed or Series A deck, that's basically the thesis, was we were going to build the NASDAQ for private markets. That was the pitch back in 2013, 14. Close corollary to that is this idea of ownership, right? Because somebody has to own the shares of these companies for you to trade on them. And when you think of public markets, you mostly think about stockbrokers and trading and things like that. But when you think of private markets, you largely think of founders and employees, like the owners of these companies that they start and work for. And our thesis had always been that labor kind of evolved over time, where you sort of, labor compensation sort of started with serfdom, where you were sort of legally free but economically indentured to where you worked and who you worked for. And then it kind of evolved over time into various forms of that, and then into wage earning. And now we're sort of in the era of payroll, where people sort of rent time to companies, or what I would call owners. They rent their time for payment. Our view is that the world will then evolve over time to what we'll call, instead of a payroll era, an ownership era, where people work for ownership and productive assets. And it's sort of my favorite line, the future is here, it's just not evenly distributed. And so if you believe that, then the future of labor compensation is in technology, where everybody owns a part of the company and they work for that equity and ownership, and that will spread to other sectors and parts of the economy. And why we think that's important is that is probably the biggest lever we have in the wealth inequality gap, right? Because wealth inequality is really the difference between owners and laborers. Because labor, payroll is a debt product, right? It's a coupon that people earn, and it has an interest rate. Ownership's an equity product that grows and that compounds, right? So like in any growing economy, where GDP grows 3%, 3%, all the owners of that economy compound at 3%, but all the laborers, don't, right? It's linear compounding, it's a bond. Our job is, can we move more people off the debt stack or the payroll stack of these companies and into the ownership stack, and start working on wealth inequality from that side, and kind of usher in this new era of labor compensation through ownership. And so you see it in a lot of the work we do. Obviously, tech is where we're centrally located. We do a lot of work in other sectors around trying to educate different markets or different sectors around ownership. I have a 9-year-old boy, he plays lacrosse, and his heroes are Paul Rabel, which is he's like the Wayne Gretzky of lacrosse. And he started a professional lacrosse league called PLL, and they're a Carta customer because they give equity to all the players. And it's really interesting. The players earn equity or vest their equity through games that they play, things like that. We're seeing it in entertainment. So entertainment's really interesting. The business model for entertainment used to be royalty-based. Like you made a sitcom, you made a TV show, and you got royalties. And now it's moving to almost more of like a PE, like an M&A business model, where you make a show and then you sell it to a streamer, Netflix or whatever. And so one of the ways that there are small pockets of kind of venture, boutique film companies which will invest in projects, almost like a venture investment will. And then they'll also give equity to the actors and actresses and the talent and even the sound people, to help kind of fund these early, documentaries and early projects. Until they can get to a liquidity event through selling it to a streamer. So you're starting to see this happen, and obviously we're trying to spread that word, that message out, and say equity isn't just for tech people. Like any industry can do this.
So I'm hearing a really big mission, and not just let's get everybody on Carta so we have beautiful cap tables, but let's address the issue of income inequality worldwide by making laborers owners.
The framing we use is can we make equity as cheap, simple, and easy as payroll? And in 50 years, just like now, it'd be weird to go work for a company and not be put on payroll. You can't imagine, of course you get on payroll. 50 years from now, people will be like, hey, you remember back in the early 2000s, the early part of the century, you just work and get cash? Nobody got equity. That's so
maybe
weird.
It'll be a verb, but are you carded yet?
Yeah,
I'm carded.
Totally.
Which means I'm, there we go. New word for you. Okay, very cool, very cool. Very big mission, addressing a very big problem. So there's a couple of cool concepts that many, and there's two I want to ask about. First is the one and n and n of one concept, and then I want to ask you about your atomic units. But let's start with the one of n.
Yeah, sure. So we talk a lot about n of one and one of n markets, and what we're referring to is one of n is the market such that there will be one of many, n competitors, right? It's a fragmented and competitive market, and an n of one market is where a winner can win the whole thing, right? There's one winner of this market. You almost think of it perfectly competitive on one side and then monopolistic on the other side of it. N of one and one of n are probably more euphemisms for those two concepts. Whenever we think about markets, it's very important to us that the market can be an n of one market over a one of n market, and that actually takes priority over everything else. And so I'll give you an example of that, where that comes in, especially if you've been talking to a lot of investors. The investment risk that they have will be market TAM, or at least that's traditionally true. I think people are starting to rethink that model, but traditionally it's been the size of the market, like how big can this market be? If you do that kind of business school model of how big the market can be, you would say things like, boy, restaurants is a great business to be in, right? Because everybody eats, right? There's a lot of food that needs to be consumed. Like we should be in the restaurant business. The reason why restaurants are a terrible venture backable business is because it's so competitive, right? It's so hard to create a moat around it, a defensibility, and sort of Econ 101, if there's competition, all the profits are competed away. And so we actually have a much more extreme version of that, which is we don't care at all how big a market is. All we care about is, can we be the dominant player in that market? And if we can be, and that's structurally an N of one market where we can be that one and only one winner, we'll go after it, even if it's a small market, which is contrarian to most venture thesis, where you have to they like databases, right? Because you're like, oh, databases, big market, right? Like we can go after it, it's a big ocean. But if you're a founder, it's really hard to compete in databases. It's super competitive. They can de-risk it because they have a portfolio of companies that they're going to go after, and they just need that one database company to hit. But if this is the only company you're working on, right, you really want to be able to win and build something of value and durability. And so that N of one, we actually have a checklist whenever we go into a new market or try to launch a new product. Sort of our analysis of how to do this, we've got like a checklist of things that we go through, and the number one is, can we make the market structure such that if we won, we can be the one and only winner, and it won't fragment into a competitive industry.
So how did you pitch that to investors early on? Did you pitch with that framing of, we're just going to crush this one market, or how did you present that?
It was really funny. I'm sure many of you are sort of raising early rounds, so I can give you my seed round stories. The two pushbacks that we had when we were trying to do e-shares back in the seed round in 2013, we raised, I think it was 1.8 million in our seed in 2013. And the first pushback was market size, like how big's the market for cap tables? The way that we talked about it was, look, this isn't a cap table company. Cap tables is the wedge into something bigger. And that bigger thing is liquidity, right? We are going to solve the liquidity problem for private companies, and that is a huge market. And to get there, we need to capture all of the securities that are out there, have relationship with the issuers, and become the transfer agent, right? We need to be the central infrastructure that can move a security from point A to point B. And to get that infrastructure, it's then on top of that, we'll add liquidity. So that was the pitch there. The other problem, or the other pushback, it will sound really funny, is this idea seems so obvious, right? Why hasn't anybody done this before? And my reaction was always, I'm like literally the least qualified person in the world to answer this because I'm doing it. Like you should literally ask anybody else other than me why they haven't done it, because I'm the one that's saying like we should do this. And it was this very strange irony where people were like, that is so obvious a problem to solve. It must be a bad idea that nobody solved it before. And it's the investor version of, there's $20 on the floor, I'm not going to pick it up because it can't be true. Like it just isn't, the market's too efficient to allow $20 to be on the floor.
Oh my God. Yeah. We talk about that here as the camel's nose in the tent, right? So how you get in that tent, right? With you just pushing apart the tent, that's the initial market. But then what's that tent, right? And investors want to hear that even at that very early stage. Tell me how this is what your big vision is, and how you're stepping into it. The obvious example is Facebook. Harvard students, tiny market, right? But camel's nose in the tent for a lot of bigger stuff.
Yeah.
Cool. Well, tell us about the atomic unit.
Yeah. So if the market, kind of analysis that we do is, we hold this, we have this kind of checklist, and it's like, can we make the market structure N of one is part one. Can we create a business model around it that's differentiated and defensible is the second one. And then the third is, can we do customer acquisition at velocity? Because obviously if you create an N of one market, you have to win it quickly enough before somebody else can come in first. So you need a high velocity distribution model. So that's like the market checklist. The product side, and I'm sure all of you are deep in product. Whenever I work with product managers at Carta or founders that are thinking about product, I always ask this kind of question of like, what's the atomic unit of the product? And it's really hard to I've had trouble like defining it. It's easier to sort of give examples. And I would argue any great product, the founder or product manager can crystallize the atomic unit really, really quickly. And so like the examples I use are like, what's the atomic unit for Facebook or Instagram, right? And I would contend it's like the photo, right? The entire platform is built around the photo. Like, how do I share a photo? How do I like a photo? How do I upload a photo? How do I download a photo? How do I filter a photo? Like, everything's built around this photo, and that's the atomic unit. And then you build the construct and the platform around the photo. Slack, right? It's a message. How do I get a message from one person to another, one person to many? How do I create threads within messages? It's all about this atomic unit of the message. One of my favorites that I always ask people is like, what do you think the atomic unit of Snapchat is? It may have changed a little bit recently, but like, that's a tougher one. And it's one of my favorite examples. I would contend it's the camera, right? They were the first to make the camera the central point of the experience, right? It literally, when you open Snapchat, it opened to the camera, right? Everything was built around the filters, right? It's the experience of the camera. You were looking through you were looking at the world through the lens of your camera, right? And then everything with stories and everything and sharing and even deleting the photos were all built around the experience of a camera versus what I would say Instagram was built around the experience of a photo. And for us, it was really simple. It was the security. Right, so the asset, right? Like everything we built around was how do you get this asset from point A to point B and record it, right? That's what our cap table business was, like issuing a stock certificate, from the company to the shareholder and recording it for the company and them to always have. And then with that framing, once you sort of identify the atomic unit of the product you're building, then everything kind of drapes around that. Carta, it's very simple. Our atomic unit's the asset, something of financial value. And then everything we built is either an asset acquisition product, an asset valuation product, or an asset transaction product. And so I can give you examples, like cap tables is an asset aggregation product or acquisition product. We build cap tables and everybody gives us their assets to manage them, right? 409A valuations, that's an asset valuation product. Our liquidity product is an asset transaction product. How do I match buyers and sellers and transfer these securities for money? And anybody at Carta that's building a product that we can't fit into one of these three categories is probably building something wrong. And so that's what we talk a lot about, is that atomic unit concept.
That's cool. That's cool. I'm trying to think about what it is for SkyDeck, which is a good question.
Yeah, totally.
I'm going to work on that. Maybe you guys will tell me. So can you think back to Henry with 2 to 8 employees, which is approximately the founders here, pre-seed and seed. Some of them have some revenue and customers. Some of them are still building products. Wide variety. We've got everything from healthcare to biotech to robots to software, crypto, everything. But think about, what would you look back at and tell Henry, 2 to 8 employees, about how to manage that phase of growth right then as a leader?
Yeah, I think the biggest, it's really funny how over time, the risk curve changes. So like at 2,000 employees now and sort of 350 million in revenue, there's you don't want to mess up, right? There is risk in doing something and screwing up. There's at the early stage when you're 2 to 8, all the risk is not in messing up. All the risk is not doing something. And there's almost this manic freneticness where you just have to constantly iterate and move so quickly. And the inertia that most people have is, we have this phrase progress over perfection, right? One of the biggest problems is you hire a really smart, talented person out of, college student out of Berkeley or, whatever. They've had 2 years experience and they've been trained their whole life not to make mistakes, right? You took tests, right? Tests are so funny. You don't start at 0 and get points for, all the things you get right and it's unbounded. You start at 100 and you get docked for everything you get wrong. We're just taught, to not make mistakes. And so they come and they work at a startup, and what do they want to do? They want to do everything correctly and perfectly and not make a mistake and be right. And the biggest, the risk curve for startups at your stage is not that you'll do something wrong, it's that you just won't do anything at all. And that is the hardest thing to kind of beat out of I think for yourself, you need to like get into that mindset, but also to beat out of your team is this execution first. Don't worry about making mistakes. That's part of the process. And the goal is not to not make mistakes, but the goal is to make them really fast, right? Which is like literally the opposite. You have to like run towards the mistakes to work them out. And that to me is, I think, what we did, this is before Zoom and everything, and everybody was like, kind of remote, is every morning at 8:30, the whole team would have to get together. We'd all meet in the office in a conference room, and they'd have to show what they did the previous day. And like literally every team, like, this is what I did yesterday. This is what I did yesterday. And that's how you just develop this cadence of like constant productivity and moving the ball forward, and then making sure that they were working on the right stuff, or like, hey, that's wrong, or let's not do that, or let's switch. But the speed of iteration is so important.
How long did you do those meetings, and how much time per meeting? That'd be interesting to dive into those details.
I think it would be an hour or two in the morning. And what I always, and your employees will, your team will complain. They'll be like, why do we have to do this? I could be working, stop micromanaging me, you're too bossy, like whatever it is. Like they'll complain about it. And of course they'll complain about it. They'll complain because they don't want you checking their work every day. And you will be micromanaging them, and that's kind of the deal. We did that forever. We still do a version of that. It's called Show and Tell. Every Wednesday, obviously we don't have 2,000 people, but the whole company shows up. And people sign up and they kind of present their work. And it's an opportunity for, at these days, it's not me like checking on them, but it's become an opportunity for, if you're, on the support team for one of our Val things, 7 levels below me, it's your chance. You can sign up and you can present to me what you do. Like I can actually see a team, and I get a lot of direct exposure. So we still do a version of it.
Okay, cool. Yeah. All right. So I thought it'd be cool to ask, a lot of these companies they have a product, they're trying to figure out the customer, the market a little bit, they're still testing, they've built something, but there's all these questions around, how do I know if it's right? How do I know if there's enough pull from the market? What would you give them for guidance for that?
Yeah, totally. I have a lot of thoughts on this, because this will never stop. Like, we're still inventing products, and we do a lot of stuff at, our number one selling product is cap tables. That's about 200 million of the 350. And we just launched a new product called Carta Deal Concierge, which I hope all of you will use. If you close a round, we'll help you close a round. We'll just make it much cheaper. Your legal fees will be a lot lower. So we've got the whole mix. And like, there's always this question of like, how do you know, we're working on something that will scale and people will use and all those things. And I think, let me caveat, I really only speak for B2B. I know nothing about consumer. I saw Snapchat early as an angel investor, and I was like, I don't get it. It deletes the photo. Like, what's the big? So I'm like terrible. I saw Peloton, and I was like, it's a bicycle that doesn't go anywhere. Like, I don't understand. So all the consumer founders, like, you can check your phones or do whatever. This is only for the B2B founders. So two thoughts for you.
I doubt that, by the way. I'm sure it's for everybody, but go ahead.
Tip one is charge early, as soon as you can. And it could be $1, like literally it could be $1. I'm not exaggerating, but there is such a difference between free and $1. Because there's something about the commitment level that a customer has to have if they're willing to pull out the checkbook, especially if they're a larger customer, because it's not really about the money. It's like, did it get to somebody important enough who can write a check, right? And did they make a decision? And then once they wrote a check, it goes on, it goes on somebody's, accounting statement. They have to defend it. And so they care. And the biggest mistake is that founders don't want to ask for money because they're shy, they're embarrassed, the product's not ready, I'm not ready, like all the kind of stuff. And then they go to take the product to market. It's free, and they get really false signal because the customer didn't pay and they don't care enough about it, right, to matter. So I really push, like, doesn't matter how much and how much it costs, charge, and your team will tell you to make it free. Absolutely, especially your salespeople, which is the irony of it. They're like, oh, make it free. And the marketing people, even now, like I, launched Deal Concierge, and the first thing I said, how come it's not selling? And the first thing the team said to me was, oh, because what we should do, let's make it free and we'll sell more of these. And it's like, it's the dumbest advice ever. Like, just don't listen. So charge for it, and then see where it sticks and where it doesn't, right? Like, what's the pitch that gets somebody to pay for it, right? Before you get to product market fit, you need message market fit, right? Like, what's the message that gets people to pay? And then once they do pay, now they're invested, which leads me to the second one is, you want customers that are really happy or really pissed. Like, what you don't want is indifference, right? Which is another reason to charge them, because you want them, if they paid for it and it doesn't deliver or doesn't do what they want, you want them to be angry, because that's where the signal comes from. It tells you what to do, and it also tells you that they care, right? If they're angry, it means you've hit a nerve. Like, something you're doing matters to them. Even if you're not delivering, it means that they wanted you to deliver so badly that they get mad about it. And that means you've got signal. What you don't want is customers that are like, it's great, good job, love it, yeah, it's wonderful, because they don't care. But that's what everybody defaults to, is because that's the easiest thing to hear, right? Nobody wants to hear the angry customer, but you actually want to create angry customers.
Yeah. As we're often fond of saying, it's better to have a small number of customers that love your product than the whole bunch that go, oh, that's nice, yeah, nice.
Totally.
And I think that you're agreeing with that. So how much should they charge? So enterprise software, right? Or an app, or what would you tell them?
Yeah, on B2B and enterprise, always go big, because you can always discount, right? And just discount all the way. Look, it's $100,000, but for I'll knock it to 20 or whatever, right? And get classic sales, right? You never give anything away for free. Like, everything's a trade. Like, the customer wants this, you'll give it to them, but they give you this, right? So it's like, the customer wants more information. You're like, great, but then you have to spend more time with me. Like, let's do another meeting. The customer wants a contract, then I need a verbal commitment, right? Like, so you do the thing, and typically what you ask for on the trade is like, $100,000, and like, there's no way I'm paying that, right? Okay, what do you want to pay? $20,000. Okay, great. I'll do it for $20,000. In exchange, though, for $20,000, you meet with me once a week for 6 weeks and give me feedback on it, and you promise to do 3 reference calls for me. And I don't care if the product's bad. You will just say good things about the product, and for that you do it for 20. So that's just like, again, the pricing doesn't matter. It doesn't matter where you land in this stage. Eventually, it will. You'll be like, optimizing every dollar and that dollar retention and gross margin and all that stuff. But at this early stage, all you care about is signal.
Right. So many questions we could ask about fundraising, about building product, about leadership hiring. What do you guys want to hear from Henry? Fundraising, product?
I just have a follow-up question on that topic. So I think Carta is free for companies who have less than 25 people. At what point did you decide to make that free for small companies?
Yeah, such a great question. I never wanted to do it. I was like, never make it free. Like, never. Like, it'll never be free, blah, blah, blah. And the team really wanted to do it. And I kept telling them no. And we're not doing it.
We're actually really happy you do that. So
Yeah,
just so
no.
you know.
I said, it'll never work. People won't care. Oh, my whole pitch to you. Like, they won't be invested. They won't take the time to really use the software. They'll half onboard, half complete it. Like, they won't value it. Like, I had all my reasons. So I said, absolutely not. We're not doing it. And then I went on vacation, and I came back, and they did it. And they were right. It like worked amazing. I was totally wrong on that one. And so the moral of the story is not, don't go like, well, Henry's wrong, we should make everything free. Like, stick with me, like, charge, don't make it free. But I think the moral of the story is 2 parts. I do think at some point there's a level of scale where you've established enough brand credibility that free is not, you have enough signal on the paid stuff that free is like this gift that you're giving to pay it forward, and there's like real value in that. And I was really stuck in the old days of like, no, like we got to make $1 for the work we do. I hadn't quite caught up to that level of scale. And then the other is like, sometimes you're wrong, right? And you just have to like you have to let people experiment. And you also have to let them be wrong. I mean, there's a lot of stuff. I've gone on vacation, came back, and I was like, what are you guys doing? Sometimes they're right, and you just give them a chance to be right.
It sounds like you trust your team, which is important.
There's like, lots of different company styles. There's top-down execution companies. There's bottoms-up innovation companies. We're on the kind of bottoms-up innovation side. And so the good news is, yes, you trust the team. People have a lot of autonomy. They experiment with a lot of stuff. There's a lot of stuff that goes on I don't even know about. And if they asked me, I never would have allowed, but they just don't tell me. And so they do it, and some of it works, and some of it doesn't work. The downside of managing an organization that's bottoms-up is like, it's like Lord of the Flies. Like, it just nothing, you never know what's going on. It's complete chaos. There's a mess all the time, and that's the trade-off.
Okay.
Yeah.
Well, how about some fundraising stories? Things that stuck out as, when I was at the seed stage, this was a really good thing I did for fundraising, or vice versa. Shouldn't have done that. But what's some good stories you have?
Yeah. So on the seed stuff, the thing I tell founders is, I think, at least I felt this way, I'm sure many of you probably do as well, is that you will mostly get no's. That's like the norm. That's the default. The reaction or the reason you'll feel you got no's is you'll be like, oh, I didn't pitch it well enough. Like, I just, if I had been a better pitcher, more charismatic, sold the vision, like whatever it is, like you would have critiqued your style and just been like, I wasn't, good enough. If I was just more charismatic, I would have pulled it off. And I actually think, especially at the seed stage, it's less about the sort of the style of the pitch, and it's more about a filtering exercise of finding people excited about the problem you're solving. Because I could have told early on, like within 3 minutes, I knew if they were going to invest or not. Because either I was like, cap tables, liquidity, stock market, right? They were like, love it. Or like, who cares, right? They just there's like a personal connection to the problem set. And if they felt that person, this is angel investing, right? It's literally stuff that I feel a personal connection to. And so I guess the thing that I encourage all of you to, think about is like, think of this as a filtering exercise, not a pitch competition, right? And so like my job is to go find the angels that even if I pitched badly, they're like, I just love this problem so much. Like, I want somebody to go solve this problem. And your job is to go find those people, not find the people that don't care about the problem and convince them to care about the problem.
Okay, that's great advice. So you're looking for people who love your problem, rather than people who are going to invest in you as a founder. Okay, that's really good advice, and I agree. I totally agree with that. I think you all know you're mostly going to get no's, right? That should be clear by now. And every no is just that wasn't the right one, right? Move on. So very, very good advice.
Yeah.
Are there any specific stories about fundraising that you recall?
Oh, yeah. I mean, I've had them all. So I've total raised about 1.1 billion, which, believe me, I don't know where all that money went either. It's like a remarkable amount of money for cap table software. So I've seen the whole kind of gambit in it, and it really changes. Like the seed pitch, when you get to like late, our last round was private equity. It wasn't LBO, it was growth investment from private equity firm. It's like totally different. So if like in early stage you're like, we do this thing, we get on the beachhead and kapam, world changed. Like that's the seed pitch. In late stage growth equity, it's like, well, and then you dial the thing and you make 2% margin improvement, and it's all like analytical, and it doesn't matter how charismatic, nobody cares. Like, I could be Obama, and they're like, whatever, show me the numbers, And so it's just like it changes, so much over time. I think that, when I talk to investors and they ask me that, I always tell the story of, so Mark Andreessen's on our board, and he led our Series E round a few years ago. And, I got to kind of know him and the firm over kind of a 6-month period as we were kind of getting ready to raise. And I remember kind of the last morning, we're running the process. We had a couple term sheets, and I really wanted to work with Mark. And so I had breakfast with him on Sunday in Menlo Park, and I basically was like, look, here's my term sheets. I'd want to work with you pound for pound. If you'll just match my best term sheet, like I'll go with you. It's like, okay, great. Thank you. Let me talk to the partners and I'll get back to you. So it's like Sunday at 10 a.m. or something like that. So I go home, I'm hanging out with my son, and he calls me in the afternoon and says, hey, can I stop by your house? I was like, sure. Yeah, he lives in Atherton, I live in Menlo, we're like really close. So he came by, he brought a Lego set for my son, and then came in and just, here's a term sheet, and just like walked me through the term sheet. And I said, great, let me talk to the board, I'll get back to you later tonight. And I tell that story because I tell investors, I say like, look, I know for you, like slinging term sheets is like part of the job, but for like an entrepreneur, it's like a seminal moment in their career. And if Mark Andreessen can come to my house to deliver a term sheet, you can go to your founder's house and deliver a term sheet. And so I hope all of you will get the experience of an investor coming to your house to deliver you a term sheet.
Yeah. Well, Andreessen is known for really being focused and dedicated to the founder, and I think that's a great example. So, all right, got some questions? All right, I think I saw your hand first. Go ahead. And introduce yourself, name and company name.
Yeah, my name is Eugene. My company is Wasper. We are making a very easy to use crypto wallet. So my question is, like in your early days when you don't have much data or you don't have much like supporting evidence, that like when you're making a decision, like how do you make a decision that you have a conviction that you're right, and how do you persuade your co-founders or your team to go in that way?
It's a great one. That's actually where I think charisma and storytelling matters. This problem will be a problem or haunt you depending on how you look at it, like forever. I still have this problem. Is how do I create alignment, right? Like how do you get people to do something, and largely against their own personal interests. Like I would say that's your founder's job, is to get people to do things that they don't want to do. Like that's the job. And like I have this problem today. One of our business lines, the margin profile of this business isn't very good. It's like $100 million business for us, but it like runs at 30% margins, and we're trying to get it to 80. And how do I convince a team that they should go solve this problem, which probably means we're going to fire 150 people if they're successful, right? 150 people of their colleagues will get fired. Like we're a software company. That's the goal. And I think there's this sort of combination of authority and charisma that goes into like follow me because I have this great vision, and like you came here because you believe in me. And then there's like what I call like play the CEO card. And I used to print them actually. I used to have this thing called the CEO card. And when I couldn't get by default, like you get the exec team to buy in, right? Like my job is to convince the exec team to do stuff, even if they don't think they should. And most of the time I'm successful. Like most of the time I have enough, credibility and vision and inspiration and all that kind of stuff. They're like, oh, that makes sense, Henry, let's do it. Every once in a while, they're just like, we don't get it. And I'll go, okay, I'm playing the CEO card. I get like 3 a year, and I just put on the table, and I'm like, we're just doing it my way. And if I'm wrong, like we'll fix it. I'll correct it. But you just have to, that's why I'm the CEO. Like you just have to do it. And you do a few of those. If you're wrong a lot, it gets harder. If you're right a lot, it gets a lot easier. I think you can be very explicit. Like sometimes you're just like, I'm playing the CEO card. Like I don't have to convince you.
Okay. Print CEO cards. Okay. Yeah.
Yeah. I'm Sahil Agarwal. We're building Encrypt AI to shape machine learning models into complex customer environments. What are some of the key learnings that you had from angry customers?
One thing is talk to them yourself. So it's really easy to like, angry customer, where's my CSM team to like deal with this? Like, I don't. So like you have to talk to them. One of the other things I tell early stage founders, maybe like a little bit later than where you are, but like Series A, here's the first thing. Even sometimes seed rounds now are so big, like founders do this. But what's the first present that every founder buys for themselves after like raising a seed or Series A? A VP of sales. They're like, I don't have to do sales anymore. Like I'm just gonna hire a VP of sales and they'll do it for me and I don't have to do it. And it's a kiss of death. because the only person, the reason why I think the founder CEO has to be so tightly coupled to the sales calls is because it's the only person that can bridge product and sales, right? So you're the only person that has the credibility. If a customer is like, I will buy it, but you need to do X, Y, and Z, you're the only person that can credibly say, we will do X, Y, and Z. And you're the only person that can go back to the product team and say, you will now do X, Y, and Z, right? And then you're also the only person that when they don't do X, Y, and Z can go back to the customer and say, sorry, like we're late, right? And that power of like connecting the sales experience to the product delivery, only the founder can do it. And now it's like really hard to scale because right now, you know, if some of you probably have some cap table problems or maybe you didn't buy Carta because we missed a feature or something, I have no idea. Right, that goes through a machine of people that like the salesperson told the, you know, subject matter person that told the support person that told the product manager that's got 15 other things that, you know, like that connection is really broken. And that's why startups actually succeed when big companies fail is because you're so much tighter than we can be. And as soon as you start, you know, abstracting that away because founders don't like to do sales, you lose that connectivity.
That's a really good point. That's a really good point. Yes, question here.
So Carta, my name is Janvi and we are part of a company called Frida and we're aimed at helping divorced women build wealth independently. So the idea of inequality, like solving that really resonates with me. My question is, I have two. Carta is such a mission-driven company and my first question is, when did the vision really begin to manifest? So what was like your real hook into the problem? And two, as like really early stage founders who haven't, you know, started making any money yet, does a lack of like a very strong vision, should we treat that as like a litmus test for a strong or a weak signal that the business is going to be successful or unsuccessful?
Yeah, it's such a powerful question. I would say we were always very mission driven. Even if you like look at like the stuff like cap tables and private stock market, like the people that were into that like loved that mission. Like most people like who cares, but like the people we hired came from the industry and were like just wanted to, you know, my commitment to them was like, hey, you come to Carta, you've been doing cap table management by hand for a decade, you come to Carta and we're going to revolutionize it. And for them, it was like the greatest mission ever, right? They were going to go rebuild the entire industry that they had been part of. So we've always had that. I definitely don't think there's a lot of, you know, rhetoric around like mission-driven companies are the best, you know. I don't think Snowflake's that mission-driven. It's doing pretty good. Like I don't think that's actually necessarily true. Like I think you can just have like really good businesses that, you know, aren't trying to cure poverty or whatever. I actually think there's like there's a downside for the mission-driven stuff, which I feel all the time, which is sometimes you just like want people who don't care that much. Like just do your job. Like you don't have to like, you know, everything has to be this big thing and we're gonna like change the world and they have lots of opinions and, you know, all this kind of stuff. And sometimes you're like, I just kind of want somebody to do what I tell them, right? And so that's the trade-off. And if you're running like which, you know, your idea is very mission-driven and you will attract, you know, people that really deeply care about it. And the plus is like you'll have a passionate, you know, workforce, you know, almost like army behind you to go do this. The problem is you got really passionate people that will like have a ton of opinions and they're exhausting to manage. And it's actually really interesting. I had this conversation with one of my executives, and she runs a team, and she leads Carta Blue, you know, has just, you know, came for the mission, stayed for like all this kind of stuff. And she's recruited a ton of mission-oriented people. And she's like, they're exhausting. Like they just like, God, everything's an argument and everybody has an opinion. And I'm like, can you just do the thing I told you to do? You know, and so anyway, that's the trade-off you're gonna have.
Okay, interesting. As a mission-driven organization, that's interesting.
Yeah.
Who else? Question on any different topic? Yes, Guillermo.
Yes. So my name is Guillermo. I'm the co-founder and CEO of El Dorado. It's a stablecoin marketplace for Latin Americans that are looking to protect themselves from inflation. So my question is the following. I was in a webinar probably about a year ago about Carta, and I was amazed about the amount of data you guys have collected on fundraisers and on cap tables from companies. So I was just wondering, what's your take on other business verticals, as like even like investing on some undervalued companies, or signaling investors which ones are the undervalued companies, depending on regions, and yeah, I'm just super curious about that.
Yeah.
What are you planning to do with all that data?
Yeah, we totally. It's such. This is the kind of perennial problem that we have, which is, okay, we've got all this data. What do we do with it? We're a little bit handcuffed in the sense that because we have the data, we can't use it. So if you go to like PitchBook, they can tell you everything about a company, right? Because it's all wrong. They've scraped it, they've pieced it together, like all this kind of stuff, so they can sell it. For us, you pay us to keep your data, and so we can't use it. Right, like I can't tell them I can't tell the world who's on your cap table. You pay us actually to keep that private. So we have this sort of weird dynamic, which is why if you look at Carta today, you're like, how do you have all this data and you don't have a data product? Right? That should be like,
yeah.
Come on, you should monetize this. And it's because we have the ground truth data that we can't monetize it. So that's problem set one. Problem two is the second thing you highlighted is, okay, you've got the network of companies and investors and the data and the information, and you're at the nexus of this. Why aren't you helping founders like us with fundraising? Right? You should just introduce us to investors, like help us raise capital. And this is a problem we've thought a ton about and continue to work on it. We are working on it. Like I hope one day I will come here and I'll be like, hey, there's a button on Carta, raise money, and you're done. Like we'll get that. Like we're working on that. Like it's a really hard problem. And the reason there's a lot of reasons that's hard, but kind of the very core fundamental reason is, especially in early stage funding, it is both a non-normal distribution. Public markets are close to normally distributed, right? That's like why Black-Scholes works, and that's why all the financial models work and hedging work, is because you can approximate the public markets as a normally distributed set of outcomes. In the private world, it's all power law, right? It's not normal distribution. It's all power law, which is also why there's no financial engineering. Like Black-Scholes you can't do a stock option on a power law, at least not in our current mathematical framework on a power law company. So that's problem one. And problem two is that because it's power law, everything concentrates into the best companies, and all those companies are not sort of commoditizable, right? What public markets did was they commoditized stock. So you could turn everything into sort of an EPS and a guess, right? Like, good EPS, I can value it, and I think it's going to go bigger, and I can buy it. In private companies, it's so bespoke. And so if we started a fundraising problem, the question is like, how do you scale it in software? Because so much of it's like Mark Andreessen going to your house and talking to you and touching and feeling the investment. And we haven't figured that out. We have a lot of ideas like, you have a lead round, we'll fill out the rest for you, right? Because once the lead's in, there's signal on the investor, there's a price, like 90% of it's taken care of, it's just filling out the round. But then it goes into like, but I want Scott Belsky on my cap table. I want this person. And so there's so much human element to it. Sorry, I'm being long-winded. It's a problem we've thought a lot about, we haven't cracked.
Absolutely. Just one more comment. I think that with all the data, it would be interesting for you to explore like a valuation standard from your side. And also something that I would love to know as a founder is the exact average of pre-seed crypto startups from Latin America, and I guess that's something quite easy for you to get. But yeah, in terms of confidential information and multiple other factors, it's not something that you can easily make publicly available.
So I'm so glad you mentioned it, because I'll do my quick pitch for Deal Concierge, which is if you get a term sheet, call us up, and then we will tell you how it compares to the average of crypto startups in Latin America.
Okay.
Okay, very cool. Now, what Henry just said actually kind of keeps hidden. There is a ton of insights coming out of Carta. Follow Peter Walker on LinkedIn. He's the head of insights for Carta. And I recently posted something that Peter did. It was the average investor equity given, and there's some new data. It's really interesting. So they are publishing some really interesting data that they've aggregated, so there's no private information. And there's a ton of good stuff there. So definitely follow.
Yeah,
follow
Peter's
Peter.
great.
Yeah, for sure. Yes, Pierre.
Thank you. I'm together with Francesco over there. We're founders of Carta. We unlock sensitive data by moving algorithms rather than the data itself. So this overlaps with what we just discussed. And just going back to the data, I'm wondering, I know you have an equity report, and I'm wondering which insights what do you want to do with that strategically, if the plan is to monetize it, which insights are missing in those reports that would be interesting to know.
Yeah, totally. Well, I guess I have a macro level perspective on the data stuff, and the team disagrees with me. So internally, so I might go on vacation and they'll
You gotta stop going on vacation.
I think data companies will become obsolete pretty quickly. I think data products will be obsolete. I just think data is going to increasingly be commoditized. And so my direction of the team is stop. Nobody today is working on a paid data product. 3 years ago, that was not true. People are trying to figure this out, and I kind of killed it, is that data is not monetizable, and if it is, it's a one-of-n market. Like, it will quickly go away. And so the strategy for us has been using data to really kind of build an ecosystem and help the ecosystem, sort of pay it forward. And through that, we will then become the kind of trusted authority. And so that's why, again, unless I go on vacation for too long, you won't see paid data products come out of Carta, but hopefully you will see lots of data analysis come out.
How long? How many days do you have to be gone?
They move quickly. It's not like I'm gone for a month.
Okay.
Yeah.
I think we have time for one more SkyDeck staff. Yes.
Yeah, so there's a question on Zoom, here, if you wanted to raise it. Otherwise, I'm happy to. No? All right. He asked, is the private market...
Sure, I can do it, if you can hear me. Yeah. I
Yes,
just wanted to ask, this is delightful, thank you. I just wanted to ask, the power law thing you mentioned, is it perhaps the case that the reason the private investments are power law driven is because we don't have someone like Carta who helps minimize the correlations that exist and therefore create herding behavior and so forth? So would Carta perhaps be able to normalize the private market if it went to that?
Yeah. It's a great question. I don't think so. I think it is the very nature of, startups and software, right? Like, why are startups and software venture backable? It's because the winners just win everything, and it's not a function of kind of the market structure or kind of the financial engineering that happens in the market. It's just literally like some ideas get off the ground and shoot to the moon, and some don't, and it's structurally what we're in. If you were like coffee shops, I'd be like, yeah, that's probably more normally distributed. Like, there's some small ones, there's some medium ones, there's a few big ones. Like that has a broader range of sort of normal outcomes. But startups are very all or nothing.
Do you have time for one more quick question?
Sure.
Luis, go ahead.
Hi, I'm Louis. I'm the CEO of GSense Biotech. We're developing diagnostic devices based on semiconductor technology. And I guess that my question is, as a large CEO of a huge company, you've probably dealt with hundreds of different investors. In your opinion, as a CEO, what's the hardest part or the biggest challenge of dealing with all of these investors with different profiles? And what would be a learning that you'd like to transmit to early stage founders looking forward?
There's sort of like people, future investors, like you want to invest, and then current investors, and like how to deal with your investors, and maybe even most of you too small yet to have boards, but at some point you'll have that. I think with prospective investors, it's I won't say anything too profound. Like, quickly filter who's interested, who's not. Always keep the option open. You never know when they come back. And the thing about the investors, especially in the early round, is like if you get one or two investors that are interested and excited about it, they know everybody else, right? And so it's actually there's like this very compounding effect. Like, the hardest part, I remember it took of 1.8 million, it took something like 3 months for me to do the first million and like 4 weeks to do the last 800K. Like it compounds because everybody's like, hey, I got this great deal. Like I'm putting in 100K, you should put in fit, and like that starts to happen. And so like you'll start to build out the investor networks. And I think everybody that passes, you're like, keep the option open. They might do the Series A, right? Like that just always happens. I think for your investors that are on the cap table already, I used to do this, like email investors, give them updates. I think it's back in 2014, that was really uncommon. Like nobody did investor updates. Now it's super common, figuring out where you need help. I think the thing, and asking for it, I think broadly speaking, you will be underwhelmed with how helpful and smart these investors are. Like, just don't expect, like, I get these investors and ta-da, like magic, like they know everything. Most, I feel like it's sort of the old adage, like those who can do, those who can't teach. It's like
those who can start companies, those who can't invest.
Invest, exactly. Like there's just sort of this, like investors are especially angel investors are founders that were successful, but not that successful, right? Like otherwise they'd still be running their companies. So like just don't. We should probably cut that out of the filming, but yeah.
No, it's all true. Okay. Yeah. Well, on that note, thank you, Henry. This has been fantastic.
Yeah. Thank you very much. Thank you.